Great. So I hope everyone can see my screen and hear everything clearly. Please do stay on mute during the presentation, and let's get started. So if you all are thinking about college, you are probably inundated with all kinds of information. Your students are probably getting mailings. You see it on the internet. And one of the things that I find tempting as clickbait are all of these best value college messages that come up on the internet. And I have to say, I'm kind of a sucker for them too. I always click on them to see what people are saying. And for a certain specific slice of student, almost all of these that you see here could be nice values, but hardly any of them will be appropriate or good values for every student. And the problem is that none of the lists that are going through this know anything about your student or your resources. And none of the colleges that are mentioned are going to be a value if the way they set their prices doesn't match your student's profile. So we're going to be talking about those types of topics a lot and trying to help you understand how to identify colleges that might be a good value for your student, because that's what you really care about. So our agenda tonight has two main components. One of them is assessing where you might get aid, and you in that case is really the student. The other part is deciding what you can afford. And in that case, the you is often the parents. Assessing where you might get aid is a matter of identifying the student's profile in terms of potential eligibility for need and or merit-based aid, and matching your student's profile with the way that colleges award aid. So if your student has a particular profile that you're targeting colleges that don't award for students with that profile, you're unlikely to get financial aid. Deciding what you can afford is making sure that you understand the true total cost of college. And when you think about that, you want to be sure to focus on the net price of a degree. You want to understand what resources you have to pay the cost. And those are typically going to be savings and money that you can pay out of income. If that's not enough, you'll have to think about how much you might have to borrow. And if you're thinking about borrowing, you want to be sure that any debt that you take on is reasonable. So we're going to talk about all of this stuff in a lot of detail. So when most people think about the cost of college, the first thing that they focus on is the sticker price. That's kind of the top line before any financial aid. At the University of Southern Maine, it's about $23,000. At Orono, it's a little bit higher, maybe 26 or 27. University of New England is $58,000 sticker price. Bowdoin is 72, and Boston College is 79,000. But it turns out that all of these colleges offer a significant amount of financial aid. And so at USM, the average gift aid for students who receive gift aid is about $13,000, $22,000 at UNE, $45,000 at Bowdoin, and $48,000 at BC, which means that the average net price, the sticker price minus the gift aid, for students who receive aid ranges from $9,800 at USM to about $30,000 at Boston College or $36,000 at UNE. But there's more to the story than that, because not every student receives gift aid. So at USM, about 90% do. Everyone does at UNE. At Bowdoin, 54% of the students receive financial aid. And at Boston College, 39% do. What that means is that at Boston College, 61% of the students there are paying the full price. 46% are paying full price at Bowdoin. When you consider the people who don't get aid at these colleges, The average net price for all students ranges from $11,000 at USM to $57,000 at Boston College. So the point of this is it really doesn't matter what colleges charge. What matters is what you are going to pay. That's your net price. It's the college's cost of attendance minus the gift aid. And you probably heard that when airlines set their prices, almost everyone pays a different price for their seat on the plane. It's very similar with colleges. Almost every student is paying a different price at a given college. So let's talk about financial aid. There are two main categories I want to focus on. One of them is gift aid. This is free money. This truly reduces the cost of college. If it's based on financial need, it's typically called a grant. If it's based on academic criteria, it's called a merit scholarship or scholarships in general. The other category of financial aid is self-help. This is not free money. It helps manage the cost of college, but it doesn't reduce the cost of college. So examples of self-help include work study, a campus job that the student gets during the academic year, and loans, money that you borrow to pay the college bill, but has to be repaid with interest after college. So when you think about it this way, it's pretty clear that gift aid is a much better form of financial aid than self-help. Unfortunately, colleges don't always make it easy to understand that. So this is an example of a letter that a college sends to a student in order to advise the student and his family of how much financial aid they might receive. And at this college, that financial aid award totals $22,000, which is great. That's a lot of money. But it turns out that of the 7 lines on this award letter, 4 of them are gift aid, 2 of them are loans, and 1 of them is work study. So when you break those down into the different categories, it turns out there's about $15,000 of gift aid, $5,500 of loans, and about $1,800 of work study. Now, $15,000 is still a lot of money, but it's not nearly as good as $22,000. And there's some important information missing. The starting cost, that sticker price, and your true cost or the net price, which is the sticker price minus the gift aid. So I went online and looked it up for this particular college, and it turns out that when you look at the sticker price, it's a little bit under $50,000. Subtracting the gift aid of $15,000 gives you a net price of $34,865 for this particular student at this college for 1 year. So keep that number in mind. We're going to return to it later in the presentation. But first, let's talk a little bit more about the types of gift aid. So we said there are 2 main types of gift aid. One of them is grants, and that's typically the name that's used for aid that's based on financial need. When they're assessing eligibility for gift aid, they're looking at the family income and assets. The main application for gift aid and student loans at all U.S. colleges is the FAFSA. So that's required at almost all U.S. colleges. In addition to the FAFSA, there's a second financial aid application called the CSS Profile. And this is required for college-funded gift aid at about 140 colleges. Now, there are over 2,000 four-year colleges in the United States. Only 140 of them are using the profile, but they tend to be the colleges that are the best known, and they tend to be the colleges with the most generous need-based aid. So if your student is applying for need-based aid, there's a good chance that you will encounter the profile. The other type of gift aid is merit aid, and these are typically called scholarships. These are based on academic factors such as grades, test scores, class rank, And this type of aid is often awarded automatically when your student is admitted. So they may send a letter saying, congratulations, you've been admitted to our college, and we want to offer you a scholarship of X. Now, you always want to double check the financial aid websites for all of the colleges that your student is applying to, because sometimes there are specific types of gift aid that do require an additional application or applying by a certain date or something like that. So make sure that as your student is finalizing his or her list of colleges to apply to, that you are checking the financial aid pages for each of those colleges. So I want to talk first about need-based aid, which we said are typically called grants. In the financial aid world, need has a very specific definition, which is COA minus EFC. And I'm going to explain those terms in just a minute. But need is the potential eligibility for aid. It's not the amount of aid that your student is actually going to receive. So let's break it down. Cost of attendance is always made up of 4 elements: tuition and fees, room and board, books and supplies, and then transportation and other miscellaneous expenses. EFC stands for expected family contribution. And this is one of the most misleading terms in the English language, because if you read it in English, it makes you think this is what you're going to pay for college. In reality, people rarely pay the EFC. What it really is just a way of ranking all of the students who are applying to college based on their and their parents' economic resources, and then they can be assessed and judged for need-based financial aid. And important to keep in mind, college aid policies vary. Some colleges award no need-based aid. Other colleges award full financial need based on the FAFSA or the Profile EFC. So depending on what your student's profile is in terms of eligibility for need-based aid, you want to be sure to be applying to the appropriate colleges that might award on that basis. If you want to estimate your EFC, this is a website you can go to, and it will tell you your EFC based on both the FAFSA and the CSS profile. Now, understanding what your EFC is helpful, but it's not sufficient. So what do I mean by that? Let's say that you go and estimate your EFC and it turns out to be 30,000. Well, at the University of Maine, that means that you're not going to qualify for any need-based aid because their starting cost is about 27,000. That's lower than the EFC. There's no financial need. On the other hand, at Bowdoin, where the cost is about 72,000, you subtract 30,000 EFC, that means the need is about 42,000. That's the maximum amount of need-based aid that you might receive at Bowdoin. Another thing to keep in mind, every college defines its idea of need, and the college's idea of need is rarely the same as yours. So we said that EFC determines eligibility for need-based aid. A lower EFC means more eligibility for need-based aid. There are 2 EFC formulas, one based on the FAFSA and one based on the CSS profile, but they both use the same basic approach, which is to look at the income and assets of the parents and the student. So there are actually 4 calculations going on in the background. All 4 of those subtotals are added together, and the sum total then becomes the EFC. A couple of things I want to point out here. For most people, income plays a much bigger role in determining the EFC than assets do. So if you look at the parent column, the assessment on income after you reach a relatively low threshold is 47%. That means that for each additional dollar of income, your EFC goes up by 47 cents. On the other hand, assets are assessed at a maximum of 5.64%, which means that for each additional dollar of assets after you reach a minimal threshold, the EFC increases by a little bit more than a nickel. For students, they typically don't have a lot of income, so income usually doesn't play a big role for high school students. But in some cases, students may have assets in their own name. And in that case, it can be disadvantageous because the contribution or the assessment from assets for students is significantly higher than it is for parents. You can see that it's 20 to 25% for students. So if a student has $10,000 in his or her own name, that could increase the EFC by $2,000 to $2,500. If it were in the parent's name instead, it would only increase the EFC by about $560. It turns out that there is a loophole that's available even to ordinary people to move assets from the student to the parents if that's a concern. And the loophole is this: if you take student assets that might be in a savings account or an investment account and put them into a student-owned 529 account, they will be counted as if they were a parent asset on the EFC formulas. So that can be a way to lower the EFC and potentially qualify for a little bit more need-based aid. So there are some special cases when figuring the EFC that I want to talk about. One of them is when there are multiple siblings in college at the same time. Historically, the parent portion of the EFC has been shared among the siblings, which can often result in a significantly lower EFC for each sibling when there are more than one in college at the same time. However, this is changing, and that's going to have it can potentially have a pretty significant impact. I'm going to talk about those changes in just a second. Another special case is related to the fact that when the FAFSA and the CSS profile ask about your income, they're asking about income that was earned in the past. So for students who are going to graduate from high school in 2024, current high school juniors, they're going to be asking about income that was earned in 2022. Well, in some cases, there might be changes in your income from one year to the other. And if your income is lower in 2023 than it was in 2022, you want to get in touch with the college and let them know. You'll need to fill out the FAFSA and the CSS profile based on the income that you earned in 2022. But what you want to do is to get in touch with each college that your student is applying to, let them know that your income went down in 2023, and ask if you can be considered for additional eligibility for need-based aid. Colleges don't automatically make that change, but they will be receptive and will listen to you if you have a good case to make. The final special case I want to talk about is when the parents are divorced or separated. And here, the FAFSA and the CSS profile have very different approaches. So let's talk first about the FAFSA. The FAFSA looks only at the custodial parent. And if that parent has remarried, they will also look at the new spouse. The profile almost always looks at both biological parents, and if those parents have remarried, they will also look at the new spouses. So the profile could be looking at the income and assets of as many as 4 different parents. Now, they do some calculations in the background that are intended to put the primary burden for college on the biological parents, but those calculations are imperfect. And so in general, it's often disadvantageous from a financial aid standpoint for divorced parents to remarry. So if you're a divorced parent, remarry for love, but don't remarry for financial aid. So we said that the FAFSA and the profile are looking at income that was earned in the past. And I want to show you the timeline of how this comes together. And I'm going to use as an example a student who's a current junior in the high school class of 2024. So colleges are going to ask about income that was earned during the calendar year that ended December 31st, 2022. You're probably getting ready to file your taxes. They're going to be due by April 15th. Your student is going to be applying to college this fall, and you'll be able to file the FAFSA and the profile at about the same time that your student is applying to college. That way, when the colleges are letting your student know about whether he or she has been admitted, they'll also be able to give you an idea of what the financial aid is that your student might receive. So that's the timeline for income. For assets, they're going to be valued as of the date that you submit those financial aid forms. So for a student who's a junior and is applying to college this fall, they're going to be looking at assets as of the date that you file those forms, which typically will also be in the fall. This is another area where there is some potential for planning that could possibly make you eligible for a little bit more need-based aid if the college awards need-based aid. And here's what I mean by that. Let's say that you have some expenses that you know you need to make. It could be advantageous to pay those bills before you fill out the FAFSA and the CSS profile. Now, I'm not talking about buying extravagant stuff just for the sake of buying stuff. But if, for example, you're self-employed and you need to pay estimated taxes, it could be advantageous to pay those a little bit earlier than you normally would, because when you pay those taxes, they're no longer going to be in your checking or savings account, and therefore will not be included in the determination of eligibility for need-based aid. So I want to show you a summary of the dates that are going to apply for students who are currently juniors in high school. For their first year of college, assuming that they start college right after high school, they're going to be looking at 2022 income. For the second year, it's going to be 2023. For the third year, 2024, and the fourth year will be 2025. This gives another potential opportunity for some possibility of impacting eligibility for need-based aid. If a student is fortunate enough to have a relative who wants to help pay for college, maybe a grandparent has been saving and wants to help pay for college, then it might be better to wait until after the final year that's going to be considered for the FAFSA and the CSS profile. It turns out that the final year that's going to be considered for the student's senior year of college is going to be the calendar year that ends when the student is a sophomore. So if this grandparents wait until after January 1st of the student's sophomore year of college, those payments will not be included in student income and therefore won't affect eligibility for need-based aid. Now, I mentioned that the FAFSA rules are going to be changing. One of the changes is that the FAFSA will no longer include payments from grandparents or other parties as income to the student. However, I expect that colleges that use the CSS profile will continue to include that as income. So even though the FAFSA rules are changing, I expect that it could still be in your interest to consider the timing of when a grandparent or other relative makes those payments. Now, if the student isn't going to qualify for need-based aid anyway, then it doesn't make any difference when those payments are made. So it's only if the student is eligible that this is going to be a factor. I've got tables that show the dates for current sophomores and ninth graders. As I mentioned, I'll put my email up at the end. If you'd like copies of these slides, I'll be happy to send them to you. So I mentioned that the FAFSA is changing, and an important question is, will the CSS profile change as well? So let's talk about those changes and what might happen with the CSS profile. The effective date for the changes is going to be the 2024-2025 academic year. So if your student is a junior in high school or younger, they will be using that new FAFSA rules for all of their college years. Most income items are going to be coming directly from the IRS. That's going to make it easier for most people to complete the FAFSA. And that term EFC, which I dislike so much, is going to be renamed Student Aid Index. Now that really doesn't have a meaning that resonates with most people, but at least it's not going to be inherently misleading. If the parents are divorced, the rule for determining the custodial parent is going to be changing. So right now, the custodial parent is the parent with whom the student lives more than half the time. Beginning with academic year 24-25, the custodial parent is going to be the parent who contributes more than 50% of the student's upkeep. I think in many cases that's going to continue to be the student with, or the parent with whom the student lives, but it's going to potentially be a little bit of a gray area once that change is implemented. College payments by relatives will no longer count as student income for the FAFSA. However, I expect that they will for the profile. And the discount for multiple siblings in college at the same time is being eliminated for the FAFSA. So what's going to be the impact of these FAFSA changes? Well, very needy students are going to benefit. It's going to be very advantageous for very low-income, disadvantaged students. Crucial question is what's going to happen to the CSS profile? And the reason for that is that most generous need-based aid comes from colleges that use the CSS profile. At these colleges, the maximum annual aid based on the FAFSA is about $7,000 to $10,000, while the maximum aid based on the profile could be as much as $70,000. So it's a much bigger deal, much bigger stakes at some of those profile colleges. Another reason that the profile, whether the profile changes is going to be important, is because many colleges that don't use the profile often do not meet full need. In other words, there's a gap between the amount of financial need that the student has based on the FAFSA and the amount of aid that the college gives. The college gives less aid than the student needs. So these are my educated guesses as to how the profile is going to react to a few of these important points. I think the profile will conform to the FAFSA in considering which is the custodial parent. That's really not going to have a big net impact on most people because, as I mentioned, the profile typically looks at both biological parents anyway, and if they're remarried, their new spouses. I think that profile colleges will continue to count payments by relatives or parties other than the parents as income to the student. And so those grandparent payments could potentially continue to have impact on eligibility for aid at colleges that use the CSS profile. And one thing that is a little bit of an advantage to people who may happen to have kids born close together, I do expect that most CSS profile colleges are going to continue to offer a discount if there are multiple siblings in college at the same time. But I also think that they're going to be looking at what college the siblings are going to. So if the siblings are both going to expensive colleges, I think that they're likely to offer a pretty good discount. If one of the siblings is going to a public in-state college where the tuition is much lower, then I think that the benefit of that multiple sibling discount will be significantly reduced. So the bottom line, don't make changes for financial aid unless they make sense for your overall financial plan. And that applies to the changes that are being made to the FAFSA, and it applies in general to changes that people sometimes think about making in order to try to become eligible for more need-based aid. I often see people do some kind of crazy things to try to make themselves eligible, and often the payoff is minimal or even zero. So we've been talking about defining the student's eligibility for need-based aid. Let's say that you've found that your student is likely to have financial need at some colleges. How do you identify colleges that are going to meet that financial need? Well, these are some statistics about how colleges meet need. And basically, colleges have three options when it comes to meeting need. They can meet a need with grant, they can meet some of the need with loans, or they may not meet all the need. In other words, they leave a gap. So obviously, the more need that's met with grants, the better. The more gap or loans, less good. So let's look at some examples. At the University of Maine, at the University of New Hampshire, the average amount met with need, the average need met with grants is under 50%. So not so great. And there's a significant 30% or more gap at each of these schools. Now, the University of Maine is almost always going to be affordable for Maine residents, but that's because it's lower cost to begin with, not because of generous need-based aid. At New York University and Ohio Wesleyan, they meet a greater portion of need with gift aid, 60 to 70%, and they gap less, 29 or 17% at these schools. So the need-based aid is better at these places than it is, for example, at University of New Hampshire. At BU and Colby, they meet an even higher portion of need with gift aid, and they have much lower gaps. And in fact, at Colby, there's no gap. Colby is kind of the gold standard. They meet full financial need, and they meet almost all of it with gift aid. So if your student has high need, Colby can be a great choice in terms of affordability. Obviously, Colby is not an easy college to get into, so that's another question. But in terms just of the financial aid, they're kind of the gold standard of colleges meeting need. Another important question, even if your student has need, and even if you identify a college that meets a significant portion of that need, will the need-based aid make college affordable? So I want to show you an example of a very generous full need college. The cost of attendance is $72,000. The EFC is $30,000. So there's financial need of $42,000. Now this college meets full financial need, but they meet the first $4,500 of need with a loan. They meet the next $2,200 of need with work study. And only after they've met some of the need with loan and work study do they meet the remaining amount of need with gift aid. So in this case, there's $42,000 of need, about $30,000 $5,000 of gift aid, you subtract the $35,000 of gift aid from the $72,000 cost of attendance, and the net price for the first year at this college is about $37,000, about $7,000 more than the EFC. In years 2, 3, and 4, they continue with a similar pattern. They actually do increase the loan amounts in those years by a bit. So at the end of 4 years, this college has met the full cumulative need of $168,000. They've met $24,000 with loans, $8,900 with work study, and $135,000 with gift aid. This student who had a cumulative EFC of $120,000 ends up paying almost $153,000 for his or her degree. So the student is ending up paying significantly more than that EFC amount. Remember, this is a generous college, and this example doesn't include inflation. So the rule of thumb is when you're thinking about need-based aid, if the EFC times 4 plus about $40,000 to account for the need that might be met with loans or work study, if that total is not affordable, then need-based aid probably is not going to be the answer to your paying for college dilemma. So if need-based aid may not make college affordable, maybe merit aid might make it affordable. So let's talk about merit aid now. And to talk about merit aid, we need to start by thinking about the business of college. Now, when most students and parents think about college, they focus on the acceptance rate. That's the percent of students who applied to a given college and were offered admission at that college. So at Harvard, only 4% of the students who apply are offered admission. At Northeastern and BU, about 1/5 of the students who apply are offered admission. And at Muhlenberg, Ohio Wesleyan, and Susquehanna, 70% or more of the students who apply are offered admission. Now, colleges certainly pay attention to the acceptance rate, but they also look at a different number, which is very important to them, and that's the yield rate. The yield rate is the percent of students who were offered admission in the spring and who end up enrolling at that college in the fall. At Harvard, over 4 out of 5 students who are offered admission end up going to Harvard. At Northeastern and BU, about 1/4, and at Muhlenberg, Ohio Wesleyan, and Susquehanna, 15% or so or less of the students who are offered admission end up going to those schools. Now, when this yield rate gets into the 20s and lower, colleges really worry about having enough students paying some portion of the tuition bill in order to help pay the bills that that college has, the fee, the salaries for professors, groundskeepers, keeping the heat on, and everything else. So what do these colleges do when they're worried about not having enough yield? They discount their price with financial aid in order to compete for yield. So this third column shows the percent of students receiving college-funded gift aid at that college. Might be need-based aid or it might be merit aid. At Harvard, 56% of students receive college-funded gift aid. So 44% are paying the full price. At Northeastern, about 80% do. And at Muhlenberg, Ohio Wesleyan, and Susquehanna, 95% or more of the students are receiving college-funded gift aid. The fourth column shows the percent of students who did not have financial need who received college-funded merit gift aid. So at Harvard and Wesleyan, they use no merit aid whatsoever. At Northeastern and BU, you can see Northeastern uses quite a bit, BU uses very little. And at Muhlenberg, Ohio Wesleyan, and Susquehanna, they also use a significant amount of merit aid. So if need-based aid may not be enough to make college affordable for your student, looking for colleges that might offer merit aid to your student could be an answer. So let's talk about merit aid in more detail. We said that merit aid is typically called scholarships based on things like GPA, class rank, test scores. It's most prevalent at private colleges, but more and more public colleges are using it now too. Here's a key point. The highest awards go to the strongest students relative to the other applicants at that particular college. What that means is that your student is likely to receive the highest merit aid at colleges that they might think of as their safety colleges. So a safety school for admission may also be a safety school for financial aid. And as with need-based aid, college aid policies vary, ranging from colleges that use no merit aid to colleges that use significant merit aid. So I want to show you some examples, and these are from before the pandemic, about how colleges award merit aid. So I mentioned that grades and test scores are factors for merit aid, and you may be aware that many colleges have gone test optional since the pandemic. That doesn't mean that colleges are not continuing to use merit aid. They are. They're basing it more on grades and other intangible factors, which sometimes makes it a little bit more difficult to estimate the amount of merit aid that a student might get. But there is still a lot of merit aid being used by colleges who are competing against one another for yield. So let's look at this example of merit aid from the time when SAT scores were generally required. So at Gettysburg, their highest merit award of about $32,000 went to students with a combined SAT of 1450 out of 1600. And if you look at the 75th percentile for Gettysburg, that's about 1410. What that means is that 25% of the students at Gettysburg scored higher than 1410 on their SAT. The lower amount of merit aid of 24,000 went to students with a combined SAT of 1300. And that is pretty close to their 25th percentile of 1280. So at Gettysburg, 25% of the students scored 1280 or less on their SATs. And you can see that at the University of Tampa and Eckerd, the pattern of the higher awards being close to that 75th percentile is pretty close. And the lower awards often track closely to the 25th percentile. So it turns out that you can make a pretty good generalization from that observation. And here's what it is. If a college uses merit aid, the best chances for the largest awards are when you're above the college's 75th percentile. So if you're in the strongest quarter of students applying to that college. If a college uses merit aid, the awards may phase out when you get closer to the college's 25th percentile. But at colleges that compete aggressively for students, they may award merit aid to just about everyone who they consider admissible at their college. So how can you identify colleges that award merit aid? Well, one of the statistics that I talked about earlier was the percent of students who receive college-funded gift aid. This comes from College Navigator. It's a database maintained by the Department of Education. And you can see that at Gettysburg, 94% of the students receive college-funded gift aid. And at Washington College in Maryland, 99% of the students received college-funded gift aid. So when that percent of students receiving college-funded gift aid is over 65 to 70%, it's pretty likely that the college uses merit aid as part of its aid awarding strategy. If it's over 80%, it's highly, highly likely that the college uses merit aid. And in my experience, I see many, many colleges where they award college-funded gift aid to 90, 95, 100% of students. So where might your student receive merit aid? Well, one way to identify some names is to go to a resource that shows, for example, SAT scores. So I want to show you an example where the SAT is about 1180. That's equivalent to an ACT of 24. And I'm going to use the US News database because they have information about the 25th and 75th percentile. At Shenandoah, that 1180 SAT is solidly in the middle of that 25 to 75 percentile. So at Shenandoah, there's a pretty good possibility of getting merit aid for this student with an 1180 SAT. And you can do a similar analysis at other colleges and see where your student might be in the stronger end of the range compared to the other applicants at that school. Prior to the pandemic, I would have advised looking for places where you're above the 75th percentile. But because of the test optional movement, that has had the tendency to skew scores higher. So you don't need to be in the top 70, in the top 25%. You can be solidly in the middle and be a very strong candidate for a pretty good merit award at colleges that award merit aid. Another resource to look for information on merit aid is called the Common Data Set. Unfortunately, this is not the most user-friendly resource, but if you want to use it, what you do is you Google the name of the college that you're looking for, and then the words Common Data Set. Once you get to the Common Data Set, you look for data elements H2A, N, and O. N is the number of students in the first year class who received gift aid, who received merit aid without having any financial need. This happens to be Hofstra University on Long Island, and you can see that 372 students had no need but received merit aid. That's about a quarter of the first year class. And the average amount that they received was about $24,000. So I want to show you some examples that I looked up using the Common Data Set and College Navigator. You can see that at VU, only about 7% of students received gift aid without having need. And at VU, only about 53% of students receive college-funded gift aid. So if I were looking for merit aid, VU would not be the top candidate. I might want to apply anyway, but I probably am not going to expect to get a lot of merit aid there. On the other hand, at Macalester and Dickinson, they had much higher percent of students who received merit aid, and you can see that the percent receiving college-funded gift aid was about 90%. At Fordham and College of Worcester, that those merit aid percentages are even stronger. Here are some public colleges. At UC Berkeley, if you apply there as an out-of-state student, you better plan on paying the full $71,000 price because they offer very little merit aid, and most of the need-based aid that they might offer is going to be reserved for California residents. On the other hand, at Maryland or URI, the prospects for merit aid are a little bit better, and at Arizona State and University of Maine, they are better still. So here's kind of the summary. The best chance for merit aid is when the college has a relatively high admit rate, a relatively low yield rate, a high percent of students receiving college-funded gift aid, and the applicant is strong relative to the other students applying at that college. So I want to show you a table that kind of summarizes how colleges award need and merit aid. And I break colleges into 4 categories. I call them the elite, the near elite, the mid-market, and the other. The elite and the near elite are colleges that you've heard of: Stanford, Amherst, Bowdoin, Colby, Carleton. These colleges have very generous need-based aid policies. They award full financial need based on the CSS profile, and they meet most of that need with gift aid. On the other hand, they use little or zero merit aid. The mid-market and the other colleges have much less generous need-based aid. It's routine for them to gap, in other words, not to meet full financial need, and they may meet a very significant portion of the need with loans or work study. But those colleges are likely to have pretty strong merit-based aid programs. It turns out that only about 100 to 150 of colleges are in that elite or near elite category. There are over 2,000 colleges in the mid-market or other category. So if you're looking for merit aid or for places where your student might receive merit aid, there are a lot of colleges that want to try to lure your student to attend by discounting their price with merit aid. So we've talked about need-based aid, we've talked about merit aid. I want to talk now about how you can estimate your net price. And the way to do it is to use a tool called a net price calculator. Net price calculators are required by law at all U.S. colleges, and the law requires them to show an estimate of the sticker price and the amount of gift aid that the student might receive. Now, all colleges are required to have a net price calculator, but they are not required to have good ones. Here's how you can tell the difference. If a net price calculator is super easy to use, has 5 or 6 questions, takes 10 or 15 seconds to go through, it probably stinks. On the other hand, if a net price calculator asks a lot of questions, then it's probably gathering enough information to give you a more reliable estimate of what your net price might be at that college. Now, don't get discouraged if you find that they seem to take a long time. They tend to ask the same types of questions. So as you use them more and more, you'll find that they are easier and easier to use. Another challenge some people find with net price calculators is that the output may not be as user-friendly as you might like, particularly if you're not a numbers-oriented person. In that case, just go back to the fundamentals. Remember, net price is the cost of attendance minus the gift aid. The cost of attendance is always made up of those 4 elements: tuition and fees, room and board, books and supplies, transportation and other miscellaneous expenses. Subtract the total of the gift aid, and the result is the net price at this college. So when you use net price calculators, what you want to do is to compare the net prices side by side so that you can have a financial picture of what the colleges are going to cost. Now, that doesn't mean the colleges are the same. Of course, they're not. And here I want to pause for a minute to remind you to be thinking not only about the dollars and cents involved, but also the college environment that your student wants. Your student may have particular majors that he or she is interested in. They may want a particular social environment that will enable them to thrive in college. So I'm not saying that you necessarily want to look for the cheapest possible college. What I am advocating for, though, is that you make sure that the college is affordable for your family. And we'll talk about how to decide if it's affordable in just a second. So I want to show you an example of a student with a 15,000 EFC, B- to B grades, and an 1100 SAT. If you look at Roger Williams, the starting cost is 60,000. They estimate a merit award of about 13,000, additional need-based aid of 6,000, for a net price of 41,000 for 1 year at Roger Williams. At Shenandoah in Virginia, the net price is about 37. At Wheaton College in Massachusetts, it's 29,000. At Orono, it's 23,000. At Bowdoin, it's 18,000. That's fabulous. That's only 3,000 more than the EFC. And at USM, commuting to college and living with your parents, the net price is about $10,000. Now, a couple of things I want to point out. I realize that commuting to USM while living with your parents is not an apples to apples experience compared to going away and living in the dorm. But the reason that I put that example on there is to remind people that there is an affordable path to college for everyone. It may not be the path that you have dreamed of, but far better to choose a college that's affordable than to find yourself burdened with overwhelming debt after college. Another thing to point out, Bowdoin has a great net price for this student, but a B- to B student is probably not going to be admitted to Bowdoin. So you also obviously need to think about the admissibility. So once you've estimated the net prices, let's think about how you're going to pay it. One thing to keep in mind is that college gift aid is already included in the net price. And many people say, well, okay, I'm going to apply for scholarships. The fact of the matter is that scholarships almost always come from the colleges themselves. Outside scholarships are very rare. Now, it certainly makes sense to apply. You might get $1,000 or maybe $2,000, but that's not going to change the overall affordability picture when you're looking at colleges that start at 50, 60, or 70,000 a year. So make sure that you focus on that net price, and then if you can get any outside scholarships, that would be gravy. The way you're going to pay the net price is from income that you earn over time. And there are 3 sources of income. One of them is prior income, money that you earned in the past and saved. Another is current income, money that you earned during the college years and can use for college expenses. And the final type of income is future income, money that you earn after college and use to repay loans that you have taken out during college. So I want to go back to that award that we looked at the beginning of this session. We said that the first year net price was $34,865. And let's talk about whether that's affordable. Well, we've got to remember that the cost of college is for 4 years because you've got to plan on the degree, not just that first year. So there are a couple of important questions to ask. 1, how much will the costs increase? And 2, is the aid renewable and on what terms? You always want to make sure that you are absolutely clear on every item of aid that a college offers, on exactly whether it's renewable or not, and on exactly what terms. Now, most merit aid is renewable as long as the student maintains a minimum GPA. Most need-based aid is renewable as long as your income and assets remain pretty consistent over time. But you always want to make sure that you're absolutely clear on each item of aid and how to renew it. So for this example, we're going to assume that the costs increase 2% per year. The aid is renewable and constant for 4 years. The student has $2,000 in savings and the parents have $25,000 in savings. So let's pay for this college. Well, this $35,000 a year turns out to be $145,000 for the full degree. I'm going to look first to the student. That student was awarded $1,800 in a work-study job, and they were awarded a federal student loan. Federal student loans are automatically available as long as you file the FAFSA, and they're always the first place to look for loans if you're going to borrow for college. But the amount is capped, and the maximum you can borrow for year one is $5,500. The maximum for year two is $6,500 and $7,500 each in years 3 and 4. The reason that federal student loans are the first place to look is because the loans are automatically available, the rates are reasonable, and there are protections for the borrower if he or she runs into trouble after college. But there is a limit on how much you can borrow. After this, we're going to look at that $2,000 in student savings. Remember, we said that student savings count more toward the EFC than parent savings. So let's use those first, and maybe there might be an opportunity for a little bit more need-based aid eligibility in years 2, 3, and 4. Next, we're going to assume that the student gets a summer job each year before college and saves $2,000 each year out of his or her summer earnings to use for tuition. At this point, we've exhausted the student resources. Now we've got to start looking to the parents. These parents look at their ongoing budget and they decide that they can spend $375 a month or $4,500 a year out of their ongoing income to use to pay for college expenses while the student is in college. Next, we're going to use about $19,000 of the parent's savings, and this fully pays for year one of college. In year two, we're going to use the balance of about $6,000 in parent savings. At this point, both the students and the parents have exhausted their resources to pay for college. The only way to pay the additional college bill is additional borrowing. And this is going to be a parent responsibility because either the parents are going to take out those loans in the parent's name, or the parents will be required to co-sign a loan that the student might take out. I always prefer to think of this as a parent responsibility because students really don't have the life experience to decide how much to borrow. And it's easy for students to take on more debt than they're really going to be able to pay back after college. So after those federal student loans, I think any additional borrowing is a parent responsibility. So the good news is that we have fully paid for this college using prior income, current income, and future income. And in this example, the student debt is $27,000, the parent debt is $58,000. Is that a good idea to borrow that amount of money? We don't know yet. We've got to answer some additional questions. The first one is, what will loans cost? Well, federal student loans for students have about a 5% interest rate, and for parents, about a 7.5% interest rate. You repay them over 10 years, beginning 6 months after graduation. And each of them comes with some origination fees, pretty low for student loans, pretty high for parent loans. So in addition to thinking about the amount borrowed, you've got to realize that the interest clock starts ticking as soon as that loan is dispersed. Now, because you're going to be borrowing for the subsequent years of college, they don't require payments immediately. So what happens is that the interest that builds up during the college years is going to be capitalized. That means that they take the total amount of interest that's built up during the college years and add it to the beginning balance of the loan when it enters repayment. It turns out that if the student borrows the maximum amount of $27,000, the amount of capitalized interest in most cases is going to be about $3,500 at current interest rates. Now, if the student borrows federal student loans, for every $1,000 of debt, that student is going to be repaying $127 per year per thousand for 10 years. For every $1,000 of parent debt, the parents are going to be repaying $143 per thousand per year for 10 years. So if the student borrows $27,000, the student's annual payment is going to be about $3,900 per year. The parent's annual payment is going to be about $9,600 per year. So that's how much it's going to cost. Is it reasonable? Well, my rule of thumb is that payments for education debt should not exceed about 10% of gross income. So let's look first at the student. If the student borrows $27,000, there's going to be about $3,500 in accumulated interest that's added to the loan. The beginning balance is $30,500. The annual payment is about $3,900. To keep that within 10% of gross income, that student needs to get a job after college that pays about $39,000 per year. The good news is that the average pay for new college graduates is $40,000 to $50,000. So in my opinion, it's not a bad deal for the student to borrow that $27,000 of federal student loans for the benefit that the student gets out of a college degree. For the parents, it's a more complicated decision because parents also need to think about their other ongoing obligations, retirement, college for other children, and so on. And in this case, I see a big red flag because when we were talking about the parents, they said they could afford $375 a month or $4,500 a year out of their income for college expenses while the student was in college. If they think they can only pay $4,500 a year during college, what makes them think they can all of a sudden go to $9,600 a year after college? That's a big red flag for me. And in my opinion, this college is not affordable for this family. So how does everyone else pay for college? The answer, exactly the same way we've been discussing tonight. That net price is the college's starting cost minus the amount of gift aid that the college might award to that particular student. The resources are what the family has to pay for college. I think that the student can get $8,000 from 4 years of summer earnings, $8,000 in 4 years of work-study jobs, and $27,000 in federal student loans. So the big question is what the parents have available for college out of savings and money that they can pay out of ongoing income. If the resources don't equal the net price, there's a gap. And the only way to bridge that gap is to either take on additional debt or to find a lower net price. So we're almost done. We're going to wrap it up pretty quickly. But what I want to talk about now is identifying your zone of affordability. I think it's helpful to make a chart with 6 squares or 6 blocks. What we want to look at is the amount of prior income, current income, and future income that's available to the parents and the student. Add all of those up, excluding parent debt, and that's the resources that are available to pay for college where the student can have a manageable amount of debt and the parents have no debt. Once you add up all 5 out of those 6 boxes, then you can look at the cost of a degree at different colleges, and then you know what your resources are. you can identify what I call your zone of affordability. That's the maximum price that you can pay without taking on parent debt, and any college that costs less than that maximum price. So this is kind of heavy stuff. I think it's helpful to keep it in perspective. I often think of it as the stages of grief. And I hate to be a dream killer, but I would much rather have people go through the stages of grief before they take out unsustainable debt than after they take out unsustainable debt. Another thing to keep in mind, college is important, but it's not the goal. The goal is to set the student up for success after college such that both the students and the parents are not burdened by excessive debt. And it turns out that where you go to college matters much, much less than a lot of people think. So some pretty successful people went to some colleges that may not be the big name colleges. The guy who started Starbucks and built it into a giant brand went to Northern Michigan University. The CEO of Walt Disney went to Ithaca College. And the CEO of Hershey Foods went to Shippensburg University in Pennsylvania. Another way to keep it in perspective is to think about what the student might earn. And it turns out that graduates of Colorado College, Connecticut College, and Allegheny College earn almost exactly the same amount in their mid-career years. It's about $108,000. The difference between the high and the low is only $1,200, but the difference in the 4-year net price is over $100,000. So if you want to find financial safeties, there are a couple of ways that you can do it. One of them is to use the numbers that we've talked about tonight. This is how I do it when I'm working with families, to kind of look at what colleges might be affordable, what the family can pay, and identifying that zone of affordability. But what if you're not comfortable doing that? Another way to find affordable colleges is to seed your list. And by that, what I mean is pick colleges that have different approaches to awarding aid. And if you do that, there's a good chance that some of those colleges will be affordable. So a public in-state college is almost always affordable. Maybe you might consider an out-of-state public flagship college like UMass. Or out-of-state secondary public colleges are often much less expensive than those flagships. So Worcester State is about $32,000 compared to $50,000 at UMass Amherst. If your student has high need, think about those highly selective private colleges. And if you're looking for merit aid, consider looking at the colleges that change lives. These are great, small, less famous colleges, and many of them use significant merit aid when they're awarding aid. And if finances are really tight and really constrained, a commuter school is always a way to get a college degree without taking on excessive debt. A final note for Maine families. FAME has a deal where if you contribute $1,000 per year into a FAME 529 account, you can get $300 a year in free matching money from FAME. So that's a good deal. Even if your student is close to graduating from high school, you could probably get over $1,000 of free money just by making those contributions to a 529 account. So we're just about done. I've got links to resources on my website. Feel free to check them out. If you're interested in getting a copy of the slides from tonight's presentation, be sure to send me an email and I'm happy to send them to you.